Well, good morning and welcome to Fiduciary Friday from Alpha Pension Group on July 17th. With me today is Rob Milas, our Chief Investment Officer, and Mark Salamone, our lead consultant. Rob, we're going to start with you to talk about the markets. Up until this point, really the FANG stocks, those big technology stocks, have read the rally. But I know this week something different has happened. And I also know for the, I think, fourth week in a row, you're going to introduce another animal to this whole thing. So take it away.
Yeah, I'm just going crazy with the animal. It's a zoo out there, I guess. Anyway, equities had another positive week this week. And as you said, the question is the rotation coming? So let's start with at the top. The large cap companies represented by the S&P 500 were up 4 out of the 5 days, and really we're up 2% overall during the last 5 trading days. So good positive news there. But the interesting news was that the small companies, again, that had been laggards, for the last number of years, quite frankly, are up nearly 5% during the week. And so the question really is this rotation in market leadership taking place? So if you look at the chart, and not only is it large cap versus small cap, but we're looking at, what different sectors in the market actually performed. And so we're seeing industrials, energy, materials, and financials. And those are traditionally what we call value sectors. And those value sectors are the ones that outperformed. So it is going to be interesting to watch. We did see BlackRock come out this morning with some very good earnings. Goldman Sachs also on the financial side report good earnings relative to expectations. So it really raises the question, is leadership changing, or is this a dead cat bounce? In other words, the areas that have got hit the hardest, are those the ones that are bouncing back the most? So let's see what the next tide will bring, and we'll take it from there.
Thanks so much, Rob. Interesting as always. And, the hits keep on coming in terms of proposed and new legislation. So we're going to talk now about some new proposed legislation that came late last week about a national lost and found. So what this is about is rollovers are a total headache, particularly because of how you can transition the money, how difficult it is. Specifically, small balances, really as defined as $5,000 or less, sometimes get lost in the shuffle. And not only is that painstaking to try and find, but if you're a plan sponsor, it can also be expensive. You're paying a per head fee or some sort of fee, most likely, to keep that balance of an old employee that has a nominal balance. But Mark, you're going to talk about actually another fee that could happen as well.
That's right. Yeah, the small balances tend to be left behind a lot of times when people are transitioning from one job to another, just because it might be the last thing you think about. And as a result of leaving it behind, it stays on a plan's account. And as a result, that means another person with the balance on your plan. And as those start to add up, you can get to the point where you overcome the threshold where then now you have to file an audit prior to filing your 5,500. That means you have to hire an audit firm, an outside party, to come in, take a look at your plan, and that can be costly. So most plan sponsors are always looking for ways to try to eliminate those participants out of the plan if they can. So this legislation is really giving plan sponsors a tool in a way to get participants out of the plan, get it to the right place, and then allow plan participants that have forgotten about the money in some cases to get access to that money down the road.
Yeah, you're right. This isn't a small problem. The Government Accountability Office released some data from a period from 2004 to 2014. 16 million accounts of $5,000 or less exist for these types of balances. So what this proposed legislation is doing is setting up basically a national lost and found, but also a way that these dollars can be transitioned to the Treasury and put into something other than a money market fund, which is typically where these assets lie. And the money will be transitioned into a target date fund, which is great. In other words, if people take their time and don't hunt down that money quickly, which is often the case, it'll be in a glide path. In other words, based on their age, it'll be in an asset allocation that is reasonable. And over time, it'll actually get more and more conservative. So even if you don't look for this stuff until you need it in retirement, it's actually going to be managed relatively appropriately given your age. So thanks for tuning into our Fiduciary Friday. We have a lot of great information throughout the week on our Twitter and LinkedIn pages, so please stay in touch. And we appreciate your time. So have a great weekend, and we'll see you next week.